This is a fundamental issue with the Trump administration. They really believe that tariffs can work.
Starting with Mexico, Canada, but clearly the EU is already feeling the pinch on the metal tariffs. We'll get a response from a European side. It takes two to create a trade war.
All of this is perhaps forcing the hands of the Europeans to be much more decisive, much more urgent in terms of potentially reshaping the Eurozone.
So I don't think this is just a game.
So welcome to another edition of What's Brewing with Matt and Guy. Matt, we keep saying that we're not running out of things to speak about, which I guess keeps us both employed. But I guess there's rather a lot in your mind right now. What's top of it?
So I think tariffs has been keeping us on our toes. There's been a seesawing.
Absolutely.
Are tariffs up? Are they out? It's like the hokey cokey. And it's interesting to think through where it's all going to land. But I guess what is top of mind for me, and I'm hoping you can help me understand a bit, is how far that tariff game is starting to play on the minds of investors, and we're starting to see it impact on equity markets and beyond. We hear talk of recession. Is that something we should be taking seriously? And how far is that linked to this trade game and the increase of obvious protectionism?
Well, look, absolutely. It's the kind of the erratic nature of the narrative, I think, that's spooking investors more than the tariffs themselves. This start, stop, is it, isn't it, is, I think, unsettling markets. We've seen equity markets pull back really quite substantially. If you think of the Magnificent Seven, they're down the best part of 17% really since the start of the year. These were the big favoured stocks there. The S&P 500 is down about 5 or 6%. To put that in context, some of the European markets are up double digits. So clearly investors are beginning to vote with their feet. They're suspecting actually it's more of a growth slowdown. You said about the risk of recession. I think it is a risk. It's a real risk. But when we look at the data, the US economy is still in decent shape right now. So it's got a lot to lose before we get to that kind of level. If we look at things like sentiment indicators, yes, they're weakened, but things like activity indicators still show the economy doing pretty good. But sentiment is important, and as that continues to get beaten up, the risk is that the growth dynamic slows, and the risk of recession certainly rises. We hear just this week from some of the airlines, they're saying that bookings are down. So clearly that's impacting their business models.
And do you think the expectation is amongst market participants, the professionals like you who are watching these events and taking decisions, is the assumption that these wobbles will send a signal that'll be heard in the White House, that we'll see some stepping back from the aggressive tariff policy that's been characterizing the last couple of weeks? Well,
it's a very good point, because I was of that belief, and I think you and I have spoken about that. I thought that actually it was going to be the markets that constrained President Trump's ambitions rather than Congress. I mean, that was something that we had said a lot of. But to be honest, the last couple of weeks actually suggest that pain threshold of the administration is perhaps higher than I might have imagined. Now, to be fair, the markets are not down all that much. I mentioned the kind of the Magnificent Seven at the extreme end of that. But, a market that's down 6 or 7%, that kind of would be a typical bull market correction. So I don't think that's enough to really change the policy. Bond yields have also come in a little bit. There isn't so much a fear about inflation coming through, but that could happen. But I think the feeling is that kind of that notion that if markets went down, then the policy would shift. I think that narrative is changing. I mean, I get the feeling that this is a fundamental issue with the Trump administration. They really believe that tariffs can work. Is that how you see it from a political perspective?
Yeah, I think very much so. I think it's notable that a couple of times over recent weeks, President Trump has mentioned that there will be some pain in order to get to the end point that he's committed to get to, and that is rebalancing terms of trade. This is reducing trade deficits, the current account deficit, with various trading blocs and nations around the world, starting with Mexico, Canada, but clearly the EU is already feeling the pinch on the metal tariffs, and we expect more to be announced at the start of April. So I don't think this is just a game. It's not a sort of performative activity from the new administration's perspective. they have a clear agenda here. They think that rebalancing the terms of trade will ultimately benefit their voter base, America more broadly, over the medium term. And they seem ready to take a little bit of headwind as they move towards that.
But what's your take? Because, I mean, again, there was this notion that Trump would be transactional. They would start heavy with the tariff front and then they would negotiate. Now, on the one hand, you could say we haven't really seen the full impact of tariffs yet. As you say, there's been a backing and forwarding there a little bit there. But do you see, reciprocal tariffs? Do you think that others are going to slap other tariffs on? In other words, is this the makings of a trade war? We didn't think so, but do you see it differently from that political angle?
Look, I think we said before, the most important thing here is what the reaction to Trump's initiatives are in this space. It takes two to create a trade war. I think the real risk point here comes, as I say, at the start of April, when we get clarity around what reciprocal tariffs look like, and then I expect in fairly short order, we'll get a response from a European side, and how aggressive that is and how far that escalates the issue is going to be really key to understanding the overall impact here.
Certainly from my side, I mean, all of this is disruptive. We said tariffs are taxes. We still believe that uncertainty around that is impacting sentiment, but also business investment and consumption. So the story is a difficult one. It's a challenge for financial markets. And I think until we see policy settle down and become a little bit, at least, just a little bit more predictive, I think it's going to be hard for markets to move sustainably higher. But I want to turn to Europe because there's a lot of bad news coming out around the tariffs and trade. One thing you could argue that is positive is all of this is perhaps forcing the hands of the Europeans to be much more decisive, much more urgent in terms of potentially reshaping the Eurozone or the European economies, particularly around defense. Are you as encouraged as some of the press headlines would suggest?
So, since we last spoke, we obviously had an election in Germany. The outcome there wasn't a surprise, but I think what has been more surprising is how quickly the incoming Chancellor, Friedrich Merz, has moved to try and work around the debt brake that has been such a constraint on German spending to date. So we've got $500 billion on the table as a proposal for infrastructure investment, and there are ongoing negotiations to try and agree a deal there before the new government, the new parliament comes into place at the end of March. So that is a more aggressive timeline than we had expected. It's a function of where the voters ended up in Germany and the fact that Merz has perhaps not got as much room for manoeuvre in the incoming Bundestag as he might have hoped. But it does mean we've got an accelerated timetable. They still need to get an agreement across three parties, and the Green Party, who weren't at the table when the SPD and the CDU in Germany, the left wing and the Conservative Party, came to an initial agreement on that 500 billion. So there's still significant work to be done to get that over the line.
That's a critical part. I mean, these numbers sound amazing, 500 billion in terms of infrastructure, potentially unlimited on defense. You get to numbers like €1 trillion, which is massive. But that sounds great. But you point out one, we haven't got this struck yet. And then even if we do get it struck, how this is implemented, surely that's going to be a massive challenge.
Well, it's a question for you as much as me, I guess, Guy. I mean, if you're looking at investment opportunities across Europe, have you got your eye on bits of infrastructure spend that you'd like to see the German government turn their fiscal fire hose towards? And I don't know the answer to that, but it's a question. You can line up the money, but if you haven't got anything to spend it on, it's not going to do you much good. I guess it could be framed as a sort of Merz put, the equivalent of the Trump put, that maybe it'll be enough that it shifts sentiment, and that has a sort of positive flywheel effect in terms of how investors view Europe more broadly. But that may be a bit of a stretch from where we are at the moment.
Well, I think all of that is positive. I mean, I was surprised, to be honest. I think the last time we spoke, I was thinking there's going to be a marginal change around the debt brake, perhaps. So what we've seen is pretty seismic in terms of the way it's currently laid out. And I do think it has the potential to reposition Europe the way that we need to see it moving. There is a greater urgency to get things done, but it has to be spent wisely. And I think from a market perspective, as a lender or a bond buyer, if you like, we want to see that the funds are kind of ring fenced, are used appropriately, ideally with some kind of multiplier effect. So in other words, you get more than your bang for the buck in terms of the way that's spent, and leads to a sustainably higher growth trajectory for Germany going forward. What is really important is it's been a catalyst. You're now speaking about potentially more mutual debt issuance. We're speaking about Spain, Italy, other countries being able to spend a bit more than they otherwise would have done on defense spending. And that is a positive, I think, in terms of moving in the right direction. But again, as always with Europe, how that's spent, where it's spent, in what countries, what kind of military hardware it's spent on is going to be clearly open for discussions and negotiations. So I'm not expecting a quick resolution to this anytime soon.
I think one interesting point to note is the leverage that the German Green Party has at this specific point in time means that I expect we will see some of that $500 billion infrastructure earmarked for energy transition and pursuing the net zero agenda from a German perspective. And I think that's important in terms of longer term calculations around momentum on the energy transition in Europe and what that's going to look like. And I would imagine will provide some confidence to those who are looking at having to put in place energy production infrastructure or looking at overhauling energy grids in Europe.
One thing that is true, I mean, this has to be paid for. It's not free. So we have seen bond yields move up substantially in terms of 10-year bond yields have gone from 240 at the end of last week to 290. To put that in perspective, that takes us back to kind of 23 levels when, of course, we were fighting massively high inflation numbers. And I think just in terms of the market interpretation of this, yes, there's an element that this will be a bit more inflationary going forward, but there's a positive spin on this. This is coming from a good dynamic, which is greater growth coming through in Europe, which I think is being seen positively. But another big positive in the financial markets in the last few days has been, frankly, around the situation in Ukraine. There are hopes that we could well get a ceasefire. It certainly seems that the Ukrainians and the Americans are getting there. I don't know where Russia stands, but do you think this interpretation is a positive? I mean, when I hear ceasefires, I always think, well, that's for a short period, and often they don't last very long. Is it different this time?
So look, I think it's too early to tell. I think you're absolutely right in saying the key question is what's Russia's attitude here? What does Putin think, and how is he going to react to a potential ceasefire proposal coming via the US? It's one thing for Zelensky and Trump to be back on speaking terms. It's quite another to ask, what does Russia get out of a ceasefire in the short term? One level, it looks like the momentum is with them on the ground. So maybe not such a great incentive from the military perspective to tie things up. Maybe on the economic side, there are more incentives. I mean, if you're looking at the potential for lifting of US sanctions, perhaps that tips the balance in the Kremlin to thinking, let's move towards a ceasefire and see where that goes. But you're absolutely right that a ceasefire does not mean a durable and lasting peace. And I don't think anything that happens in the short term around Ukraine is going to remove the critical security focus and pressure on Europe to step into the breach now that the US has made very clear they're not going to be funding the defense umbrella for Europe in the way that they have since 1945.
Well, Matt, I think on that note, I think the next time we chat, maybe we'll see if that ceasefire is there, or if it's holding. There's certainly so much going on, so much, I guess, difficulty in terms of coming to clear conclusions, all of this. I think the dialogue is very important. So as always, very much enjoyed the chat. To all our viewers, remember, please like and subscribe. And we look forward to, again, speaking to you, hopefully with some better news in the months ahead.